Welcome to Tuesday Talks. Today we're going to talk a little bit about mortgage. Let me go ahead and share my screen with you guys and we can kind of get started here on our panel today. So here we are.
All right. Well, why don't we get into it here? So welcome everybody. Thank you so much for taking some time out today to join Tuesday Talk with Radius Agent Realty. We've got Michael and Rafael who are going to talk a little bit about mortgage financing. Before we jump into introductions, just a few housekeeping items. As you join, feel free to chat in from where you're dialing in from in Colorado or California. And anything that you're particularly excited about learning today, we'll make sure to cover questions and comments towards the end, but you can pop those in the chat and we will get to those. Let's move on to the next slide. Awesome. Well, I'll go ahead and introduce myself. My name is Kaylee and I'm the Agent Partnership Manager with Radius Agent Realty. And what we want to talk a little bit about today before we get into the main topic, just a little bit about Radius. So for those of you who are not familiar, Radius, we've been empowering agents since 2015. So we started as a community for agents to network and share feedback with one another. So think of it as a purely real estate social media feed. So from there, we heard agent feedback and that there was a need for an agent-to-agent referral marketplace as a tool within our community. So we implemented that addition to the platform, and we now have about 70,000 users nationwide. So definitely recommend, if you're not part of the Radius community, popping on there and seeing what it's all about. We also have a couple other products that are super helpful to our agents, and then of course, agents nationwide. Radius Assist, this is our ISA concierge product. So we have our ISAs who will help to qualify and convert your online leads for you. So if you're an agent anywhere in the US and you are generating online leads, either real time or maybe you have some bulk leads that just need re-engaged, highly recommend you check out Radius Assist. This is a huge asset for agents who are looking to create some efficiencies in that process. And then finally, we recently introduced Radius Agent Realty. This is our modern tech-forward virtual brokerage. We are licensed in Colorado and California. We put a huge emphasis on helping to optimize and or create agents' personal brand. So if you're someone who's interested in kind of exploring what that would be like, maybe you've thought about reintroducing yourself with your brand or finding ways to engage with your clientele, we should absolutely connect and talk a little bit more about that. We are a flat fee brokerage that puts a lot of emphasis on continued support. So starting with branding all the way through the process. So we'd love to chat with you at some point, either myself or Michael, and introduce you to the brokerage in a bit more detail. So let's hop over. Michael Bardales, he's going to be our moderator today, chatting with Rafael. And Michael, I will let you share a little bit about yourself. Oh, I think you're on mute.
Don't you love Zoom when you forget your mute button? You would think like a year of Zoom, I would know to press unmute. I apologize, people. But anyways, welcome everyone to our event today, How to Get Creative with Financing here in 2021. As we know, there's a lot of things happening with the real estate market, in particular to lending. We know lending has an effect to real estate. So let's talk a little bit about that today. I just want to introduce myself. I'll go back and share my screen. I've been with Radius since October when we first launched, but also previous to my real estate career in sales, I was actually a lender. So I definitely know lending as well, like the back of my hand. I definitely am still licensed in regards to it. I just use it just so I can stay active, but I don't practice this as much as I do real estate. But I just want to introduce myself first. I'm going to go back to sharing my screen here. And before we begin, and before I share my screen, I just want to bring up something that sometimes us as realtors do. So we get a lot of leads that come in, and sometimes we ask the lead first and foremost, are you pre-approved? If they say no, sometimes we're hesitant to take on that lead. We think sometimes in our mind that, look, if this person's not pre-approved, they're not serious, so on and so forth. So I'm going to show you guys a little trick that you can do to actually see if this person is actually pre-approved without actually going through the pre-approval process. So let's go back into this. I'm going to share my screen again. Forgive me for the delay. So I want to talk about debt to income first and foremost. In regards to lending, there's about three components that everyone looks at when it comes to lending. They're called the 3 C's. It's collateral, it's capacity, and what I want to mean by that, meaning it's the capacity to pay back. Now, debt to income ratio is probably the most important thing right now. Before, most people think it's credit score. Most people think, oh, I have an 800 FICO score. I have $1 million in the bank, but you cannot prove your income. It's going to be tough to actually get loans. Oops, sorry about that, guys. Let me go back up. My greatness, I would have these issues now. Hold on, you guys, I apologize. Sorry about that. So I just wanted to show you guys what debt to income ratio is and how we can calculate it, okay? And then I'll get into Rafael really quick. So to calculate debt to income ratio, you need to add up your monthly bills on the credit report, okay? First and foremost. Then you divide the total by your monthly gross. The lower the DTI, the lower the risk for lenders. So for example, let's break this down really quick. So we take a household income of about $15,000 a month. This individual has $3,500 towards rent payment or a new housing payment. They have $1,000 worth of credit cards, $750 worth of car payment, and $450 worth of student debt. What you do then is you add up all this debt, and that debt comes to $5,700, and you divide it with their grossly monthly income. And from here, that comes up to 38% debt to income ratio. That's a good ratio. That's what lenders want to see. So when you're asking these individuals, when you're taking a call and you're getting the leads, start to ask them, so how much is your monthly rent right now? How much is your total credit card payments? Do you have any car payments? Do you have any student loans? Now, just keep it to credit report, okay? When you're doing that, add all that up and just say, hey, on a monthly basis, what is your household income? If they give you that info, which I'm sure they will, this will prevent you to understand that this is actually a good client right here, okay? So this is a little trick. Just take this down, understand how to calculate debt to income ratio. This has been around for quite some time, and this can help you guys with your leads, okay? So that's a little tip that you guys as real estate agents can do prior to actually going out and showing homes. Now I want to introduce Rafael. Rafael, you there? How you doing, man?
Good, yourself?
Awesome. So a little bit about Rafael before I want to introduce him. Rafael's been 12 years in the lending business, but before I give a background, why don't you tell everyone a little bit about yourself?
Oh man, I got into real estate pretty much at the height of the recession. No one was really hiring, so I was working for Bank of America, Chase, Wells Fargo, doing all sorts of loss mitigation, REO, loan mods, pretty much anything you can think of when the crash took place back in 08.
Yeah, good times. I remember I opened up my mortgage company in 07. So that was a smart year to do that. But let's get into it, Rafael. So let's talk a little bit about some guideline changes and loan limits. Tell us a little bit what's happened here with the conforming loans.
Conforming loan limits just recently all been increased. And for the new county limit, it's 548,250. And every county is going to be different. And if you notice, Michael's highlighting all the different counties in California, that gives you the loan limit per unit. And it will obviously go up if it's a 2-unit, 3-unit, 4-unit property.
Right.
And
So what area are you in, Rafael?
I'm in Los Angeles.
So this county, we look at Los Angeles County, and this is your guys' limits there, correct?
That's right.
Awesome. But you look at Madera. Look at Madera. How it's like, oh, but do you know where Madera is county?
It's near Fresno, right?
Right, exactly. So yeah, so this is all the difference here, everyone. So if you want to ever check out loan limits or whatnot, they just extended them. And when did they extend these loan limits and made them higher?
Well, technically, they already took effect like last month. It just recently happened, and all the brand new lenders are pretty much accepting these loan limits.
Awesome. Now let's talk a little bit about rates. How are they doing?
Well, rates have changed. I was doing purchase loans 3 months ago at 2.875 to 2.99 if your credit score was over 680, and I was able to get back like say $1,000 or $2,000 worth of credit for the client. And now it's changed. I'm doing purchases, say conventional and high balance, so loan amounts up to 800,000 at 3.190, and you're getting about $3,000 back right now. But the rates have slowly been inching up since we since we changed pretty much the president.
Right. So if you look at it here, everyone, in January 28th, right, kind of like we're election, like you got a new president, about 2.73 is what you saw for rates, right? That was like in January, late January. And now we're about 3%, right? So it's almost a 0.25% to 0.75%, a 0.25% higher than what you were in January. You know, the one thing I recommend, Rafael, for a lot of these people when they see rate increase is actually to get 3 different payments based on 3 different rates, for example. So right now, if you're at 3%, get a quote for 3%, 3.25, and 3.5, because it's going to take time, right, to kind of find a house.
No, definitely. Well, you can lock in your rate while you look for a property. I wouldn't suggest that right now because the market's pretty volatile.
It
It
is.
can change day to day. We've pretty much in the last 3 weeks, we've had 2 or 3 rate changes daily. So yeah, getting 3 rate quotes for those price ranges gives you good ideas. Like, okay, this is the monthly mortgage payment that I can't afford. And it gives you some leeway. Because right now, every property out there, like in the LA market, if a property hits the market, there's about 10 offers and 5 offers are sight unseen. And that's in just the first day or two.
Yeah, we're seeing that in the Bay Area too, and probably like all over the markets. I was talking to someone in Colorado, and they're actually going through the same thing as well. But let's talk a little bit about now non-traditional loans, because that seems to be the thing that's happening now, right? So when rates get a little bit higher and people can't qualify anymore, they start looking at these non-traditional loans. Can you tell the audience a little bit about those non-traditional loans and what kind of programs they have?
There's in the non-traditional space, it finally just came back when COVID hit. All the banks stopped lending on these types of products, so non-traditional loans are back. And what exactly that is? It's different type of loan types where you have stated income options. And if you're self-employed, like being a realtor, or you have a client that's an Uber driver or a gig worker, or just pretty much is self-employed, there's still ways of getting them qualified for a loan, even though their tax returns don't show their true income. So one option is you can see the average deposits of their bank statements. You can also look at a profit and loss program where a CPA letter would just write off what their total net income is, or owner occupied stated income has finally come back and pretty much is 25% down and no income is verified. So you don't even need tax returns, paycheck stubs, or anything of that nature.
Yeah, and I just want to give my example, Rafael, because you just did one of my properties, right? So
Yeah.
we're on title. My wife's on title to a property that's a family property, but we did not want to take on the debt. So we had my mother-in-law, who's actually been the owner of this property for quite some time, and we did a stated program with you, right, Rafael? I mean, literally,
Yes.
she's 85 years old. The rental income is not really being shown or whatnot, and you were able to get us a 30-year fix at like 5.5% stated.
Yes.
So yeah, you guys, there are deals out there. I'm an example of one of them. So I, get with Rafael after this, but these are those things. But people get scared sometimes, Rafael. So let's talk a little bit about that. So these short-term loans, 3 to 5 years, 5/1 ARMs, interest only. You hear a lot of negative stuff about that, but tell us a little bit about the positive things of getting these type of loans.
It's different for every client, but there are a lot of positive effects. Like if you get an interest only loan, say for 3 years or 5 years, say you see yourself pretty much having an income increase in the next 3 to 5 years. This lets you get you into a property and you can make the interest only payments. Yeah, your principal doesn't go down, but if you like, you can always make an extra payment towards the principal if you need it. Or within 5 years or 3 years, whatever that fixed payment is, you'll have a higher salary. And then you can do a refinance at that time and pay principal interest. And when you're doing a 5/1 ARM or 7/1 ARM, that means it's fixed for that period of time and you have a lower interest rate for that time. So pretty much you're adjusting your tax returns or you're adjusting your income, and that's the benefit. You come into the property at a lower rate, and when things get better on paper, you can do a refinance out. And when it's a short-term loan, 12 to 36 months, this is perfect for clients that are getting investment properties, clients that can't source their funds because they left $100,000 underneath their mattress and they put it into their bank account the next day. We've all had that issue with clients. That's when interest only loans come into play. And yes, they're 10 to 12% interest only, but the thing is there's nothing being verified. So remember, this is a band-aid and not a long-term solution. This lets you get you into the property. You don't have to source or season any of the assets, and you get you into the property. And then once you're ready to pretty much help your client get into a refinance, you'd end up doing that.
Yeah. And I like that you said that these are Band-Aid loans. These are basically rebound situations, right? So you're taking, and that's the thing about that I think individuals need to understand is that when you get an interest only loan, it's just obligating you to the interest. You can always pay principal, and it's easy to calculate your principal payment and also your interest only payment as well. So take that into consideration sometimes when we go into these deals, because 5/1 ARMs aren't that bad. They're actually kind of good. You can leverage a lot of things, right? So if you're actually looking at investing, you might want to consider an interest only on your owner occupied home while you're doing another interest only on the flip. So there are different products out there that can complement what you're doing when it comes to your real estate game or whatnot, but you can always pay your principal. That's definitely there. Tell us a little bit what's going on in regards to the Fannie and Freddie affecting investment loans.
Well, what's happening there, they increased their hits to the rate. So now to do a traditional full doc loan, when you're doing conventional, rates are going to be in the high threes, 3.875 to 4.25. And they're going to ask for more documentation. They're going to want to see that you've been receiving rental income to verify that your clients have been paying rent. And also you need more reserves, anywhere from 6 months for the subject property and 2 to 3 months for every other piece of real estate that you guys own. So the biggest difference right now is that the adjustment has changed and the rates are going to be higher. And it's better to go through a stated product now instead of going full doc.
Yeah, and we get it done quicker. So tell us a little bit about it, right? So let's talk a little bit about bridge and long-term financing as well. So can you give everyone like a definition of what a bridge loan is? Because I know there's a lot of out there and there's a lot of advantage of taking out a bridge loan. Do you mind covering that for us?
The bridge loan is pretty much a short-term loan. It can be 12 to 36 months, and it's interest only. And normally they take 25. It goes as low as 20%, 20 to 30% down, and the rates are going to be anywhere from 8 to 12%, and it's interest only. And it's specifically for non-owner occupied. I do have one special program that is owner occupied, and pretty much the scenario goes like this. Say if your client is listing a property right now and they want to buy another property, but they don't have the down payment yet because they have to sell the first house. So if there's enough equity in the listed home, I can go ahead, get a bridge loan out of the listed home, take out the equity, so that lets your borrower buy another house while that sits on the market. So those are the two different types of bridge loans for owner occupied right now.
And that's a huge advantage, because I think the issue with people trying to sell right now is not selling, it's where they're going to go afterwards. Right? Like, yeah. How do I even combat that? So sometimes listings have to go like contingent to finding another house, and you're going to lose a lot of people in that market if that's the case, because like you said, rates are going up. So those individuals, if they're like saying, I can buy something at 800 at 3% right now, but if I have to wait till you find a house 3 months later, that 3% might turn into 3.5. So, yeah. And then same thing for the bridge, you finding the house, right? So like if a seller's finding the house, they can get a bridge loan, secure a great 30-year fix instead of having rates go up as well. So that's really good. So you had mentioned here, credit score does not matter. Tell us a little bit about why it doesn't matter so much.
For bridge loans, we're looking at the collateral and the down payment. So we're hedging our bet. So if you're putting 30% down, there's enough equity in the property, and you're putting enough down where, so to speak, there's enough skin in the game from the consumer or the client. So the investor or the private money lender, we're going to be okay with you doing that. And during that time, it's our job as well. Like my firm, we have a different approach. We're not just going to get you the short-term loan. We're going to coach the client to make sure their credit scores get fixed. You pretty much have to get it up to a 620 and higher to help you get into an FHA loan or a conventional loan. So there has to be an exit strategy. We're not going to leave you just high and dry. So credit scores don't matter, but there has to be an exit strategy. So you have to work with your realtor or work with your lender.
Yeah, I like that you said that exit strategy, because in real estate, you can always get into a deal. You could probably always get into a loan. It's how you get out of it, right? Because like you said, these are short-term loans. And if you're not doing the exit strategies plan in order to get your credit score up, you're going to have to refinance back into a loan like this. And you don't want to do that. It's like you said, it's a Band-Aid situation. It's to help leverage something so you can get ahead in your real estate career, or be it that. Now let's talk a little bit about rental incomes. That's something that we did for us as well. Tell us a little bit about the products you have for rental income.
So rental income, it's one of the best loans out there right now, because it's literally, it's 25% down on a purchase. And this goes for nationwide minus like 4 or 5 different states that we're not lending in. As long as it debt services, you'll get more preferential rates, where rates are going to be in the low 4s. And if the market rent doesn't cover your mortgage, that's what debt service is. We can still get the loan done, but the rates are going to be anywhere from 5.875 to 6.5. And these are 30-year loans. You can get them 30-year fixed, 5/1 ARM or 7/1 ARM. And there's always a prepay on any of these types of loans, because they're considered business purpose, because they're only for non-owner occupied.
Let me ask. So 5.5%, that's what we got on our 30-year fix. And I don't think it's bad. We have a 3-year prepay penalty, and definitely giving out some data here. It was a cash out refinance as well. And 5.5, I didn't think that was bad at all. We're definitely debt servicing it. It's principal and interest or whatnot. But let me ask you this. If I went through full doc rental income sort of program, what kind of rates are we looking at there?
You're going to be looking at 4.25 to 4.5. But also yours was very special because your zoning was different. It was legal non-conforming. So if we went to a regular bank, they probably would decline it as well, because that's an exception that we were able to get.
And that's the thing with the loan that we have. So yeah, you're right. It's a single family home that was converted to a duplex and grandfathered in, right? So that's what was my situation. And I was denied by 3 different banks before I came to you. Yeah. We started our refinance with you in October on this rental income, and October through think the end or mid-February, we found out that we can't get refinanced through these other banks. We called you. You just went straight stated, and within 30 days, I think we got our funds yesterday or something like that.
Yeah.
So
exactly.
Yeah, I think rental income right now, and are we talking acquisition as well for rental incomes?
Yes. Rental for acquisition, 25% down. You can do 20, but usually when it's lower leverage, they're going to want more reserve. So when they talk about reserve, you're talking about principal, interest, taxes, insurance, and association, if there is one, like if you get a townhome or if you get a property that's in a PUD. So you're going to multiply that payment multiplied by 6, and that's going to give you the amount of reserves you're going to need on top of your purchase price.
Nice. So again, we'll take a scenario here. If it's 10% down of 20% down of say 600,000, that's 120K, right? If the debt there on a monthly basis is 3,000, you're also going to need 6 months of that, which is $18,000. So 120K for down payment, everyone, plus about 2 to 3% for closing costs. And then you're going to need about 18K in reserves afterwards as well. So again, a lot of power behind these like long-term rental situations.
And
let's talk about
a little bit about going back to the long-term rental. This kind of helps your investor clients. I have a lot of clients that I put them in this product versus a full doc loan, because not only are they busy, but they own like 6, 7, 8, 9, 15, 30 properties. I have clients that have over 10 properties, and they're not full doc clients. They make $10 million on their tax returns, but they write it off and they only make $100,000 a year. When you have 10 properties, you're not going to qualify. And just the documentation alone is going to kill the loan itself. You're going to need tax rolls, home insurance, mortgage statements for every property. And you're not going to want to go that route. It's going to be a messy loan transaction, and it's going to take time, and you'll piss off an investor. I've had that happen to me personally. So that's why I steer them to the stated type products. It's going to be more lenient, and they're not going to ask for tax returns or paycheck stubs and things of that nature.
Right. And they're going to take your rental income as your rental income, where if you go to conforming, they discount it, right? I remember back in the days when I did lending, I would take $1,000 payment and had to discount it by at least 30%. Even though they were getting $1,000 for a monthly payment, on record for lending, we had to show $700.
And I think 30% vacancy factor.
Right. So and that's the thing about lending, everyone, when we talk about income. Uncle Sam allows us to write off, but lending doesn't consider that write off as sort of negative. So if you sit there and you have $500,000 a year and you know that's what you make, but you're writing off 200K and then bills and so on and so forth, really in the eyes of a lender, you didn't make 500,000. Is that right, Rafael?
Yes.
Yeah. So be careful with the write-offs at the same time, especially if you're looking at that. But the alternative, bank statement products. So that's a really good product right there. Now let's talk about everyone's favorite. I want to leave this a little bit lower towards the end, but fix and flip financing. I know we got a bunch of these realtors, even myself, that's been calling you about like things like this. So let's talk about these loans real quick. So tell us a little bit about, these fix and flip financing and what we're able to do as far as not only acquiring the property, but actually getting money to fix up the property.
So fix and flip financing is usually a 12-month term. It's going to be interest only. It's a short-term loan. It helps you get into a property that you're going to flip. So when it comes to this, it depends on experience. So LTVs on the purchase price is going to be anywhere from 10 to 25%. If you've done more than 3 flips, you can buy a fix and flip for 10% down, and we can do 100% of your rehab funds. So it's very important when you're submitting loans to me or anyone else and doing fix and flip financing, you need to make sure your construction budget is very detailed, because they're going to say your construction budget hypothetically is $150,000 to fix up the house. Every lender, we're going to give you put you on a draw system. So once you do 30% of the work that you said that you will complete, we'll give you 30% of the draw, so you can go to your second half of your project. So having a really tight construction budget is very key for fix and flip financing.
Yeah. So let's break that down a little bit, right? So let's take $1 million ARV, for example. Okay. So you have $1 million ARV, guys. And then from there, your acquisition is I don't know, say $500,000 right there. If you go 65% value of the million, that's a $650,000 loan. So that means that, Rafael, you get your $500,000 acquisition, and then afterwards you have $150,000 that you can use for your rehab. That's what he said. You got to be careful with that, because if it goes over that, then that's out of your money. So for example, if your budget is 200,000, 150 comes from the loan, the other 50,000 would have to come out of your pocket. That's what you're saying, correct?
Yes. And also that rehab budget that you do submit to us, we do share that with the appraiser, so they have an idea of how the house can and will look to get us that after complete value.
And then
So
it gets
that's
a little
another
easier
important piece of
afterwards.
these loans.
But it gets a little easier afterwards. So yeah, I would, highly recommend itemizing a list, getting someone to really do your budget when you go with that. But like also too, like you just said, like after I did my 4th flip with this investor, things get a little bit easier, doesn't it?
Oh, it gets a lot easier. It's just like rinse and repeat. You just put it, we pretty much just change the construction budget, purchase price, and all the basic stuff of the subject. And that's literally it, an address. We're good to go.
Yeah. So the more we do as far as them. So again, the first 3 times are going to really be sticklers about that. Once we return their money, make it that. By the 4th or 5th time, it gets easier. By the 7th time, you're cruising. So yeah, it's a little bit in the beginning, but to know that, if you're a seasoned investor, all you need is 10% down, and then you get 100% financing. Man, that's some powerful stuff right there. But also too, these are things that we can give to our, not only us, but also to our investors as well. And you're doing this nationwide?
Yes.
With the exception of these few states here, right?
Exactly.
And I'm hopefully I know my acronyms correctly, but is that North Dakota, South Dakota, Minnesota, and Vermont?
Yeah.
Okay, I did go to school, so that's awesome. All right, now let's talk a little bit about commercial. And I think right here, everybody, rental income, great. I believe that as well, which, we're talking about this. But commercial right now, I believe there's huge opportunity in commercial. So let's talk a little bit about what you have available for these commercial things.
All right. I'm going to go off of just the non-traditional stuff, because everyone knows what SBA is, or I'm assuming everyone knows what SBA financing is, or getting prime rates going to Bank of America or Chase or Wells Fargo. So when it comes to owner occupied properties, when it's industrial, an office or retail building, say they're not showing all their income on their tax returns, so they can't go SBA, but their bank statements are very heavy. If the owner is going to be the owner user, I can use the deposits in their business bank account. And there's no other bank that can do that. We can do 10, 15, and a 30-year loan on that.
Wow.
which is pretty much a game changer. I've done a convenience store in Florida, a empty warehouse in Georgia, and uh, a restaurant in Maryland. So there's a lot. This product line helps anyone that's an owner user that does a lot of write-offs. And from
Right.
the stated route, we have options. Either if it debt services, you have a loan, and if it doesn't debt service, I have another lender, that another bank that I work with, that we can get it done with.
And you guys, we're going to get clear to our questions soon. So if you guys have any questions for Rafael or myself, please go ahead and start sending them over to Kaylee and we'll do it. But, in regards to this, Rafael, back in 07, when the market crashed, right, there was a huge foreclosures. And I think a lot of people are looking at like, there's going to be a lot of foreclosures, so on and so forth. But at the same time, we know that banks don't like to foreclose. It's weird, isn't it? Like you
Yeah.
would think that a bank would like to foreclose. Everyone thinks that, but it's actually the opposite. And you can tell them why banks don't like to foreclose.
They're in the business of lending money. They don't want to become a property manager and handle that property. That's not their business. So they want to focus more about lending, and they don't want to worry about evicting a tenant or removing a tenant if they have to, and then listing that property for sale. That's a business model they're not in.
And also too, if you think about what happened in 07, 09, everyone's like, well, look what happened there, so on and so forth. Well, it was unstable income. It was a lot of stated information out there as well, but also it was a reactionary thing that banks did because that's all they knew to do was to foreclose. And when that happened, everyone, that's when gentrification came, right? So that's when people that were in these neighborhoods for quite some time took out equity on their property. They were then foreclosed on. They had to leave to go to another neighborhood, and then privileged people were able to buy it at a cheaper rate, right? That's not going to happen, I believe, this time around. But however, there is something that's going to happen here in commercial, I believe. There is, if you guys see, a lot of vacancies when it comes to commercial. And I would say that because now that we're starting to open up and things are starting to happen, I would start looking at commercial, maybe adding that to your arsenal, and maybe even having some of your investors look at it. Because I'm seeing a lot of great opportunity here in commercial when it comes to retail, industrial, office. I mean, what do you think about commercial?
Industrial and warehouse actually have taken off even more so because of the pandemic, because everyone's ordering online, whether it's Amazon, Whole Foods, shopping online, anything you can think of. We need more storage. Warehouse and industrial has taken off. So it's harder to get industrial and office and warehouse space, and rents have actually gone up. So has medical office. Medical office has increased in the market as well. When it comes to retail and regular office and hospitality, they are hurting right now.
Yeah.
There's been higher vacancies, they've been closed down more. And right now, like you said, the banks may do some loan modifications, or they may just ditch the property so you can get them at a discount. Hospitality is the biggest asset class, and office, that's going to be at a discounted sale.
But also, I think with commercial, you can get creative, right? So think about it in this way, right? How many times have we seen condo conversions, right? How many times have we seen different things? I've seen a developer take a church and turn it into condos. You got it's a little bit of funkiness, don't get me wrong, but I've seen that. I've seen industrial spaces turn into residential spaces. And when we're hurting from housing, sometimes you got to look at commercial and see how maybe we can convert commercial into housing. And I've been through that process when I was doing fractional TIC financing in San Francisco, where we had to do condo conversions, right? It was a lottery in San Francisco, and they allowed you to convert it. I think now, because housing, there is a shortage here. Look at these hotels, look at these different places that may be able to convert them into residential potential. And that's where I see like a lot of things happening. But yeah, retail right now is definitely tough. I mean, even in their open up, they're at 50% capacity. But I definitely think there's something here in regards to commercial lending for sure.
Yeah, there is.
Now, Kaylee, do we have any questions from the audience? I'd love to like give out some pointers here.
We sure do. Okay, so let's kick off with this one here. I think it's a good one. So, Rafael, what are you recommending to your previous clients for refinancing? Is that something that you're proactive about?
Right now, I am, and it really depends. When you're talking about refinancing, are you talking about commercial properties or residential? And if it's
you could probably cover both.
okay, for right now, when it comes to refinancing, you're getting rates anywhere from 2.99 to 3.25. and you're going to see the best rates at a 15-year loan at 2.49 to 2.75. I don't ever recommend anyone ever doing a 15-year loan. One, it increases your debt load. So if you want to get into an investment property or a second home, your debt to income ratio is going to be higher. And second, there's no personal benefit. If you want to get a 15-year loan, get the 30-year loan. Your mortgage payment will be at a 30-year price. But if you want to, you can pay the 15-year price and just pay it off in 15 years as well. But you get that added benefit of, hey, I don't have to make that extra payment of $1,000. I can just pay the $2,000. You can just go ahead and do that.
I like that strategy a lot, Rafael, because you want to be obligated to the lowest possible payment. You can always pay more, right? So why not get obligated to a 30-year fix and still make the 15-year payment? Because 1 month you might need that extra payment, so on and so forth. So I think that's a great strategy when you take interest-only loans out, or you want to get a 30-year fix and you're all about paying it off. You could, but you want to make sure your obligation is the lowest possible so you can have more opportunity to use your DTI towards more investment properties.
To answer your question, as far as and cash out refinances, there are, just on my block alone in my neighborhood, 1 in every like 4 homes is pulling out money and they're remodeling. Everyone's getting brand new pavers, paint jobs, like they're just tricking out their houses because money's never been so cheap. Money hasn't been this cheap in the last, it's never been. This is the record lows that we've ever had. So right now, pulling out equity would be smart if you want to fix up your house and you also want to invest and get a second home or an investment home. Now would be the time.
Okay.
Nice.
All right. So I have a question here from Jacqueline. Is it wiser to purchase and or finance commercial property through an LLC or hold in a trust, S Corp? How would you answer that one?
That's more of a tax professional type of question. But to be honest with you, what's the purpose of it? Is it, if it's used for if it's an owner user building, I would do it in any type of entity. It doesn't really make a difference, because I would end up, me personally, I'd pay myself rent and then write it off. That way I'd benefit both ways. I'm making an income and also I'm getting to write off. And also I'd put it into my depreciation and things of that nature, just so I'd cover myself. And say if it's an investor purpose, again, this is just my opinion. I'm not a tax professional. If you put it under an entity, you're pretty much reducing your liability. So if anyone ever, as stupid as it sounds, falls on your property and they want to sue you, they can only sue the LLC. They can't come after the individual. In California, they will try, but they're not going to be able to. They're going to go after the LLC or the entity that owns that building. So it's honestly personal preference and liability issues. So you should definitely talk to a tax pro for that.
Yeah, and in regards to like an LLC, S Corp, they all have the different like tax benefits or whatnot. But you know, the one thing I want to say about commercial, if we're looking at purchasing, is look for private owners right now. Don't look for the ones that are big, represented by these big people. Private owners right now want to cut a deal. Trust me. And if you're looking for retail space for maybe your boutique store or something like that, private people are the best. So there's a strategy in Oakland called Pop-Up Hood. And I really, really love this strategy. What they did pretty much were their small business owners went to these private landlords and asked them for rent for 6 months free while their business gets established. At month 7, they agreed to pay a portion of the rent of market rent. By month 12, they were paying full market rent, and then they took on a 5-year lease. So if you think about all these vacancies right now, it's hurting more of these private owners than big corporations that are like owning all these buildings. So if you're looking for strategy in regards to that, you could probably get into that for probably really cheap as far as purchasing it or leasing it as well. So look into that strategy where you talk to these private owners and work out deals with them. I was in a building back in for the last 7 years, actually. I went in there with that strategy. I went in there saying, hey, I can only afford $600 a month, but I want your whole building. She gave me the whole building. In the 12 months, I actually paid half that rent. In month 24, I paid full rent. And then she had a tenant there for 5 years. When I left, because she did me so well, I actually brought someone else in that signed another 5-year lease on that building. So this landlord had 11 years of leasing based on this strategy. So I think there's a lot of things that you can do when you talk to private owners, unlike, the big people that own these big buildings under LLCs as well.
That's a really good point, Michael. We actually had a transaction that we did a couple years back. My dad and I, we pretty much went to a hotel in Arizona. One of our buyers wanted to make a purchase. It was a $4 million hotel. And we told them we'd make a deposit of $200,000, and the seller was willing to go into contract with us. So what happened was our client took over management and managed that entire property, gave the owner royalties for 2 years, and then we did a SBA refinance on that property.
Yeah, that's why I love commercial, man. You
So
get
going
creative.
after what you're saying, yeah, going after the actual owner and asking for a seller carry or seller financing, you're gonna strike a better deal.
I love that. And there's some comments just from you answering that question that exactly what people were thinking or hadn't heard of that before. So that's helpful. A question here from Joe. How would you do a home upgrade while you own a home?
What do you?
Hire contractors. I take it you mean by getting money for that home? Is that what you mean, Joe?
We'll see what he comes back with.
Okay,
yeah, we could.
but to answer your question, if it's the equity portion, there's a new product that just came into the market that we just got, and it's a totally stated product where usually it's for self-employed gig workers and just people that don't want to verify their income right now, and it acts as a HELOC. So you can qualify. The minimum credit score is 680. You can cash out up to, I believe, 60 or 65% LTV of your property, and there's a 5-year drawing period. So hypothetically, you get a $300,000 loan, and in 3 years you pay off $100,000. If you wanted to, you don't have to do another refinance. You can draw that additional $100,000 again. It's a pretty nutty product. It just came out.
Yeah, and that might be an answer for some. There's some companies I hear out there that give seller money to fix up their houses, So I think we have an answer for that, right? Because some of these companies say it's exclusive money for our sellers, and these are one of the strategies we can use for our people that are looking to fix up their home that we're looking to sell, right?
Yeah. This is geared towards mainly owner occupied, but since it's owner occupied, there's no prepaid penalties ever on anything that's owner occupied.
Got it. I think this one is, it's a good question, and it's two-part actually. So for Michael and Rafael, Michael, how do you go about partnering with lenders? And then on the other side, Rafael, how do you go about partnering with realtors?
For me right now, when I look at lenders, I look at communication. The reason being is that sometimes in a hard market, you're going to get bad news. And for me, sometimes it's hard to get that bad news. And when a lender doesn't answer my call because they're not understanding how to explain that hard news, it kind of gets frustrating. And they think sometimes maybe it's because we're going to get mad or something of that magnitude, but we need to strategize around that. For me to be in a refinance from October all the way to February, and my lender's telling me, don't worry about it. It's in underwriting. I'm going to talk about it. It just pushed us further along, where I risk rather hear the news up front, like, hey, this person doesn't have any money. Hey, we have to do this. So I think communication is super, super key nowadays between lenders and realtors, because we are going against 100 offers. We are going against the same people. And with lending right now, we're battling people that have same FICO score, same down payment, same everything. So we need to talk and we need to communicate with each other to figure out how we both can get into this offer. So that's one thing. And I kind of, not to be too bad, but I don't really look for lenders that have too much refinance business right now too, because sometimes it's boggling down with the purchases. So, I look for communication and those that really specialize right now in just purchase business.
For realtors, that's a super loaded question. One of the things why I joined up with Radius is because they help with a lot of my back end stuff and real estate transactions. So I am personally building a real estate team, and a lot of things that I'm offering them is their own dedicated online loan application form, We're going to be running Facebook ads. I run Facebook ads right now for two of my agents that we work with. They're not part of my team, but I run Facebook ads for buyer and seller leads, and they've been doing pretty well. We have gotten some people getting pre-qualified, and we've gotten some listing appointments. So we focus on, honestly, social media and Facebook ads, and we also manage their CRM, because a lot of the guys that we deal with, they don't care to use KV Core or use their own CRM. We handle their social media, we handle their leads, and we help follow up and pre-qual their clients.
Okay. Yeah, that's kind of a bit of a sneak peek here. So both Michael and Rafael's socials are listed here. Highly recommend following both of them for more content like we covered today. And Rafael, the lending expert, you also are a realtor with Radius Agent Realty. So maybe you could just talk a little bit about why it makes sense for you and your business to hang your license with Radius, so that you can kind of capture both businesses.
Yeah, Radius makes it super easy. That's why I signed up. One of the biggest things is compliance for me. I can't handle compliance for both companies. It just becomes too overwhelming. Then I can't focus on what I really want to do, is get more loans, sell more houses, or help more of my clients. So hooking up Radius, they have an in-house TC, which is money. Like anyone that needs help with admin, she'll do everything from once you submit the property to them, the purchase contract, she'll take it over from there, and she'll get all the documents, disclosures, and whatever else you need. And then you can go focus on whatever it is, getting more business in. So just having a smooth, seamless transaction, and also being able to brainstorm with all the real estate agents. We have a personal Slack, and me being more of a lending expert, I always need help with like random stuff. And I just go onto the Slack network, and other agents and Michael himself has like helped me out tremendously. So things like that really help versus just being a solo agent and doing two businesses. It just becomes overwhelming.
Yeah, I remember when you first talked, you wanted a company that would complement what you're doing right now. And I think that's what, Radius is about. So this is our little plug right here that, yeah, Rafael is a CEO, has his own private money company, lending company, conforming FHA. That's what you've been doing for years. You now want to get in real estate. You added Radius to that platform. And now it's complementing both you doing deals on the real estate end and on the lending end. And I think that's what our company really is about, is encompassing like other business that you might do while you do real estate. You're not unit driven. You don't have to close, 40 units just to make that dollar amount. You can close 15 here and make that same dollar amount as you would at a 80-20 split at another brokerage. So it's great that you joined our company and you actually brought your company to this company.
Yeah, and one of the biggest things is I've heard from other agents working at Remax and Keller Williams in my neighborhood in San Fernando Valley in Los Angeles. They're very adamant. It's like, okay, if you go to the listing, you can only get 2%. Don't drop it down. Don't go 1% or 1.5%. They have their own kind of like rules and regulations per their branch. And a lot of the agents, that rubs them the wrong way, I've noticed. And I've heard this from multiple agents. And Radius kind of gives you that autonomy. Hey, go do whatever you want. It doesn't even matter. You just have to be in compliance. And at the end of the day, the transaction fee with the TC is only $900. So you're giving yourself that much more freedom to do whatever you want. And you also get a TC for $900. And that's super cheap. That buys you more time to focus on whatever you need to. So Radius makes sense. Made sense for me. So that's why I'm here.
All right. Well, I think that's a really good place to kind of wrap up here. So just so that everyone knows, we did record this event and we will share it on our social channels. And you can also follow us on social media so that you can stay up to date on all the upcoming events that we have. We try to host similar events to what we did today. So Tuesday Talk, we either bring on a coach or someone like Rafael with a specialty. We just want to make sure we're adding value where we can to our broader community. And then Michael and I are happy to connect with anyone later this week or maybe in the next month or two as you start to look forward to the rest of the year and what your goals are, and we can connect and talk about how Radius can help align with those.
Yeah, and everyone, every other Tuesday, I'll be hosting Tuesday Talks. We're going to be having conversations like this with agents within our company that are doing some good things. The next topic we're going to talk about is some lead generation avenues as well. Rafael, thank you so much for coming in, and I highly recommend, Rafael, you talk about communication. Definitely this gentleman has that communication style, text messages, updating all the way from loan application all the way to signing. Rafael was there for me and my family, and that meant a lot to us. So thank you again, Rafael.
Yeah,
Thank you guys, everyone, for attending our Tuesday Talks. Please follow us on social media as well. We'd love to hear from you guys. And any more information you guys need in regards to lending, Rafael's the guy, but also feel free to reach out to Kaylee and I about our brokerage as well. So enjoy, everyone. Peace, love, and real estate.